morning, everyone. Today's the 26th of August. This is Brad Matheny. I've been putting up a couple videos recently. You know, I did a ton of videos in the past. And what's interesting to me this morning, as we look at the data, is how this NASDAQ daily chart has really rolled to this lower high on Friday compared to the SPY. Now, the big breakdown in Bitcoin, obviously, is quite interesting in the sense that, you know, I predicted that would happen many months back. In fact, I was looking up the video, and here's the video from many months ago, suggesting that we were going to be rolling down into an October low. Granted, I didn't catch this move up to 123, 124. I predicted this double topping pattern would take us into a potential July low and then potentially into an October low, maybe even lower. And really, my target levels were, if I remember right, around the 97,000 area, and again the 65,000, maybe all the way down to 40,000, 38,000. We'll see if this actually plays out. But right now, what I found very interesting was the fact that the NASDAQ set up this low. Now, see, now it's going to let me draw. It wouldn't let me draw when I did this last time. So I don't know. Long and short of it is, you know, we have this excess phase peak pattern. And of course, there's a lag. That's fine. So we have this excess phase peak pattern coming into here. We've got the roll up here across this high. We are looking at this flag length being a potential move down. So, you know, if we were to look at this breaking downward from roughly these lows, we could potentially move into consolidation down in this area on a broader breakdown. Okay, it's not letting me draw again. So we could easily, and I know everybody's going to say, but Brad, that's, you know, 24,000 to 12,000. Hey, you look, this is what the data shows, okay? Anywhere potentially in this range could potentially be a real zone of interest. And like I suggest, that's why I try to tell you, price is the ultimate indicator. These are the defense zones. Notice how I kindly drew this by error on purpose here. But long and short of it, you know, a 50% retracement would put us into this area. A 60% retracement would put us into this area. And that is a substantial breakdown, guys. That's not just that's a 26 to 31% breakdown. If something like this happens, I think you're going to be looking at, you know, some sort of a moderate crisis event, maybe involving hard assets. I keep hinting around hard assets. Pay attention. Hard assets being, you know, real estate, commercial real estate, banking, finance, what have you. But the long and short of it, we are getting a breakdown of this standard deviation channel. We are technically kind of breaking down through this excess phase peak breakdown pattern, and we could be looking at a fairly major breakdown. Now, ultimately, you know, if we stop anywhere in between here, even if we stop back over here, just below this low at 618, that would still be a 30-some% pullback. And I still think we could very easily in this range, you know, see some lows down in here somewhere. So be aware that, you know, I'm not a doomsayer. I'm just telling you what price is telling me right now. Many of you will argue, well, what would be the catalyst for something like this? Okay, well, you want to know what would be the catalyst? Adjustable rate mortgages have been skyrocketing. Average 5.1 ARM rate, and two, it was as of February 2013 with a low of 2000. This is on point. What percentages of U.S. mortgages are adjustable rate mortgages? As of 2019, were 7%. I read an article today that says adjustable rate mortgages in 2024 were over 40%. So apparently, adjustable rate mortgages have been skyrocketing over the last couple of years. So at the time, 30-year fixed rate, adjustable rate applications rose 9.2% in 2023. So normally it's a 3-to-1 or 5-to-1 ratio. March 20, more recently, applications have been declining, making up only 6.7% of all applications for the week ending 14. But I believe this has been accumulating. 8% of houses, the majority were fixed rate mortgages. Long and short of it, I believe you're looking at there's adjustable rate, holds prefer arms, fixed rate, adjustable rate mortgages making a comeback. That was 2013. I read an article that said 40% roughly of loans in the US right now are adjustable rate mortgages. And that's very likely because of the high interest rate and the fact that the interest rates may move higher still. So here's your catalyst. What happens in an adjustable rate mortgage is people get into them. They think that rates are going to decrease. I think the Fed is going to have to raise rates. Once they get off their 3-year or 5-year fixed rate, which is normally just interest only, then they adjust to the current rate. And with interest only going to, a rate right now compared to where they were back in 2013, 2000, well, not 2021, 22, with very low rates, you could be looking at a sticker shock. Really mortgages going from, $2,000 a month or less to $5,000 a month or more with interest rates moving higher. So there's your sticker shock right there. There's your catalyst. Let's see. Here you go. When was this? 2024. Average contract, interest rate, fixed rate mortgage performing balance, 7.2 sign. Share of arms rose to 7.8. Okay, that was in 2020. Yeah, okay, go back. I know, I have ads. So that was in 2024, I think. Let me go back and look. Yeah, May 2024. So we're a year later. So these borrowers are really at risk, in my opinion. And again, I think that you're going to be looking at some real consumer issues over the next couple of days, weeks, and months. So now, Bitcoin has collapsed. It is trying to find support right now, but it's broken through the lower channel. We are going to be looking at an excess phase peak pattern here, rolling up on out, breaking down below the flag low. We're looking at this flagging range setting up, potentially another move down, and potentially another move down into the extreme low, ultimate low. So this puts us at a consolidation range somewhere in here with an ultimate low target somewhere down in this 90 to 85,000 area. Sorry, that's supposed to be a box. So understand that we're looking at a pretty big breakdown here for Bitcoin as well. From these highs here down about 30%, maybe longer. Remember, we also have this bigger, broader excess phase peak pattern here that sets up a very clean structure, which would indicate, again, as I showed you in my video, a much deeper contraction potential. So if you look at this from a standpoint of what could happen, we could keep moving into this area and try to bottom down in this area, just like I suggested back over here. So notice I don't use indicators. I'm not into indicators. I think they are helpful, but price is the ultimate indicator. We're getting a pretty good solid breakdown here. And then lastly, I will show you this, which is that gold and silver are starting to make a move. I think this is going to be a very big move, possibly up 6, 7, 8% in the next 20, 30 days. I'm not going to show you the one chart that really paints a picture, but I'm going to just tell you right now, watch gold and silver. I'll put the hint out. 36.50 plus, and over here 40.50 plus. Actually quite a bit higher here, but 36.50 plus here. I think we're good for a $250 move. I really do. Okay, so pay attention to how the SPY and the QQQ are playing this trend out. Okay, really, I mean, we're looking at a pretty solid potential for a breakdown here. And when I say a pretty solid potential, it may not happen tomorrow. I'm just giving you a warning that these rolling trends, RSP, I think it is. Yeah, equal weight. Look at this double topping, just like I warned you. Double topping pattern right across here. Very clear rejection. Excess phase peak pattern rolling all the way down, rolling all the way up. Double topping, excess phase peak. Here's our flag length. If we were to duplicate the flag and break downward, I mean, it's scary, but understand that this could be, if it's full measure, could be a 36% decline in the markets. And what do I think this really boils down to? Look, I'll give you a little hint, okay? We've had many years of excesses since COVID. So when you come right down over here to COVID and you take a look at these excesses from 2008, 2009, in my opinion, this is again my opinion, a standard mean would probably put us right across here. Okay, an upper level mean would put us right across here. And a lower level maybe down in this area. So, given the excesses of COVID, the excess money printing, the Fed, the rally, the speculation, is it ungodly that we could see a duplicate move coming back to this area? No, look at this, guys. If I take this measured move, the flag range, move it from the lows to here and then double it down to here, look, it comes right back down to the mean price level, which interestingly enough is the mean price level here and the mean price level here and the mean price level here. So Brad, how is it likely that this could happen? Well, this is excess money printing. This is a big speculative bubble. If this happens, which I doubt it will right now, I don't believe it's going to happen right now. I believe we're going to move into a pullback that's going to be more along the lines of this type of a mean structure. I believe that's where we're headed right now, potentially down into this upper support. Basically over into this area. Well, I believe we're headed down into that area, not this low. Ultimately, yeah, we're going to come out here and we're going to probably move down to that low or this mean structure. But right now, I think this pullback is very likely to try to come right back down into these lows. So hypothetically on this, RSP would be 140. That would be, let me do the math. That would be about a 27% pullback down into these lower channels back over here in 23. The SPY would then be a potential pullback into these channeling levels here. And what we would be looking at is a potential pullback here. Possibly down in the 400 area, about 37%. I believe that is possible and that is likely to happen if we get this breakdown. And I believe the reason that is likely is that we would be reverting back to this mean channel which kind of runs right across here. Right down there into that mean channel, which puts us right into this area. So, am I a doom and gloom sayer? No. What I'm saying is I think there's going to be some type of an event that is going to prompt a breakdown. We could easily target these areas based on my analysis. This will likely prompt the Fed to make a move, likely deflate assets, could be related to some of Trump's policies. But you need to be aware of where we're at and how this is breaking down right now, because even though I'm not going to come out and make an all-out prediction that we are breaking downward. Come on, guys. But I do believe we're getting to that point that we are exhausting. We're getting weaker volume in the uptrend. We're not seeing that same kind of buying pressure. I think that we've reached that top. And like I showed you with RSP and DDM and the NASDAQ, you know, if you come over here and you look at the NASDAQ, we're already getting that increased selling pressure. You see this right here, guys? We're already getting that increased selling pressure. Sorry, I'm rendering something in the background, but if we continue to get this higher volume on a breakdown, there's a very good chance we're coming down at least into these areas 18,000, 17,000, 16,000. I'm just telling you, it's a very good chance we're going to break down and get this ugly move before October, November, December. Okay, guys, I'm going to let you go there. I've got to run to my doctor's. I'll talk.